Good evening, everyone. Welcome. Please give us a minute or two. We are just waiting for a few more participants and then we are good to go. So maybe just another 1 to 2 minutes before we start. Thank you.
Yeah, Shalini, let's begin.
Yeah. Thanks for waiting, everybody. So good evening, everyone. And on behalf of the entire Renaissance team, a very warm welcome to today's call. Thank you so much for taking the time out to join us today. It gives me great pleasure to announce the launch of our international fund, Renaissance India Growth Fund. This is a GIFT City domiciled US dollar denominated Category 3 AIF or alternate investment fund. And this fund would primarily be an inbound vehicle for international investors looking to access high quality, on the ground fund management expertise in listed equities in India. To tell us more about the offering and why India continues to be such a compelling opportunity for international investors, whether NRIs, foreign individuals, family offices, or even foreign institutions, I would like to hand over to our founder and CIO, Mr. Pankaj Murarka. Please feel free to post your questions in the chat box, which we will run through at the end of Pankaj's session. So with that, Pankaj, over to you.
Oh, thanks, Shalini. Good evening, friends. Very warm welcome to all of you all, and I appreciate all of you all taking your time out this evening for this discussion. So I'm very happy, as Shalini said, we are very happy to launch our Gift City Fund. We've been wanting to do it for quite some time, but finally we are there. Obviously we see a tremendous opportunity to bring a lot of capital back to India, be it from NRIs or the Indian diaspora. My conversation engagement as I've traveled across Middle East and US and some part of Europe as well in the last 2 or 3 years, I have seen very high interest of people wanting one from the NRI community, people who've been there and living there for a long period of time, wanting to invest into India, and unfortunately struggling with not getting a good vehicle or a right vehicle. So I think this is our effort to plug that gap in. And apart from that, even from international community, both family offices or HNIs or even for institutional investors, there's a very high level of interest in India, and for rightly so. I'm sure all of us know this. So I'm very pleased to bring this, and I certainly see a great opportunity for all of us and for all of us at Renaissance and for all of us collectively to really bring a lot of capital back to India and do a great job for all our investors and prospects. So with that, maybe just give me a moment. I'll bring up a deck and which I'll use to guide this. Since I've been told and I see a lot of people probably we are talking for the first time, maybe I can make a quick introduction to the firm and our investment approach, and then talk about market outlook or how we think about India, and also about this whole Gift City product. So just give me a moment, friends. I can bring up a deck to guide our conversation. And feel free to ask as many questions as all of you all have, friends, so that we can make this discussion more meaningful and interactive. Yeah, just for the benefit of everyone, I thought I'll give you a snapshot of, brief introduction to Renaissance. Renaissance is a firm now, we are in our 7th year of business. As an organization now, we are about 90 people team. We have steadfastly in our last 7 years stayed focused on alternate assets and equities and alternate assets. So all of you are aware and are participants into our domestic PMS and AIF products, and now we have this Gift City offering. Across everything we do as a firm, we manage close to about $500 million of assets now. And over the last few years, I'm sure many or most of you engaged with us. We've built a very senior leadership team at Renaissance to really take this firm to the next orbit, and we're already seeing a lot of traction in our business. And now we have sales presence in 6 cities outside of Bombay, and we'll just keep expanding our presence to get closer and closer to clients and as well as to all the partners as well, as we work very close, as we engage deeply with you and work closely with all of your friends. I'll skip the traditional, I'm sure, meaning most of you guys know me, so please allow me to skip that. But let me take this opportunity to introduce some of the senior leadership team at Renaissance for the benefit of everyone. Shalini is here with me on the call. Shalini is an industry veteran. She having spent 28 years in the industry, and in her previous roles, she has worked with some leading institutions like Kotak AMC, ICICI Pru AMC, and Alchemy Capital. Shalini drives business and helps me run the organization. So she plays a very central role in building Renaissance. Ninad is our Chief Operating Officer, a very seasoned chartered accountant with 20 years experience, 20 years plus experience. And he's worked with some leading institutions like Citibank, Vistra, and L&T Infotech, and he heads our operations now and compliance. Sanjay, my colleague, he heads our research and also runs a few funds for us. Sanjay is again a pretty seasoned analyst, 20 years experience into equity research, and has worked with some leading firms like JP Morgan, Kotak, and few others in his career. And Alok heads products and alliances at our place at Renaissance, and Alok again spent 16 years with Nippon AMC before he joined Renaissance. So as you can see, it's a pretty experienced senior leadership team at Renaissance, and there are many more probably across other business functions. But it just gives you a glimpse into some of the senior leaders at Renaissance, which are the building blocks of this organization and driving this organization. In our last 7 years, and which is what makes us feel excited about launching this product. We've had clients across all the major geographies, and we've only seen higher and higher interest from clients across different geographies to participate into our India funds, and which is where we thought that this product really helps us to get closer to the clients and give them a better access to Indian markets in dollar terms. Maybe I just want to, while all of you all are very seasoned, this thing, I thought now it's Renaissance, we've had a 7-year journey at Renaissance. I thought I'll spend a few minutes on this slide as to what are we doing at Renaissance. Yes, I understand and that it's a fairly competitive market out there because there are quite a few long only investment managers like us ourselves in the alternate investment space. And last 7 years, as most of you all have seen, our funds have done reasonably well despite challenging markets cycles at different points of time. So what is it that has really helped, or what is, because this question I think does come or crop up in minds of some people whether this performance is sustainable or not. One, I would presume, and all that all of you all will agree with me that 7 years is a fairly long period of time. If it is sustained, then obviously it's not a flash in the pan. More importantly, what are we doing, or what is it we are doing which is leading to this outcome? So I thought, let me share some, give you all some insights in terms of my thinking process, philosophy, and investment process. So I've always said, friends, one, whatever I'm trying to do at Renaissance for the last 7 years is no different than what I've tried to do with some of my previous organizations in my previous roles that I've been around for 20 years before I started Renaissance. As investors, one thing I learned early part of my career is that you have to invest with conviction. There's a saying that in equity markets, the bulls make money, the bears make money. It's only the hogs who don't make money. So people who keep just vacillating are the people who don't make money at any point of time. It's very important as investors, we are very fundamentally oriented. We do fairly deep research into our investing companies. We take a long while to build our conviction into our investment ideas before you, so a long while to build that conviction and before you put our money at work. And once we have that conviction, we demonstrate that conviction in our portfolios. I've always done that. I've never shied away from doing that just because of fear of getting it wrong. And we have demonstrated or displayed or always carried that conviction in our portfolios. It has worked for us for most of the time, but we've had our shares or points of time where something has not worked for us. But on balance, we've had more rights than wrongs, and we've had a fairly high strike rate given, our very patient approach to investing. So one thing I think really helps us is the deep conviction we bring to our investment portfolios. And that's backed by our very thorough or deep fundamental, research that helps us build that conviction. And I think I like to believe that that certainly gives us an edge over a lot of our peers. When Renaissance started 7 years back, friends, Pankaj Morarka had a track record, and many of you or most of you knew me in my previous with my engagement with my previous professional roles. But Renaissance did not have a track record. The good thing is, I'm very happy to share that now Renaissance has a 7 year track record of funds performance, and it's very pleasing. Some of our funds are both our large cap and flexi cap PMS on a 5 year basis are ranked amongst the top five, second or third best performing PMS in the entire industry in India on a pan-India basis. So, and that too, this is we're talking about 3 year, 5 year performance track record, not 6 months, 1 year. So I'm very happy with what we've been able to achieve in terms of performance over the last 5 years. And I have every reason to believe that, we will put in our best effort to carry this forward. As investors, all of us know, friends, one, markets are very fast and markets tend to be somewhat ahead of the real economy. We always say that markets are forward looking and markets are ahead of the economy. And it's something I learned again, early stage of my career, that if you really want to be good at investing into equities, because equity is a forward-looking asset class, it's very important to be ahead of economic cycles, and which is what we try to do or we practice. So as a consequence, we tend to have a very sound understanding of both top-down macros, and we do a fairly detailed fundamental research on a bottom-up basis. And we have a sound understanding of top-down macros, not only from an Indian economy or Indian perspective, but also from a global perspective. And that really helps us because I believe that now India being the fourth largest economy in the world, one cannot remain isolated from the world or immune from global economic cycles. And capital is free, capital flows freely as far as stock markets are concerned. So even if some global event has no direct economic bearing on India, Indian markets will still respond to that because capital will respond to it. A lot of global capital will respond to that event. So markets are truly integrated. And for an investor to do well, it's important to understand economic cycles, business cycles, and stock market cycles. And then position your portfolio in terms of investing or in terms of taking money off the table of sectors and stocks. So this is something which we really strive for at Renaissance in terms of bringing a very sound understanding and having a view on how economic landscape both globally and locally will evolve, and positioning a portfolio accordingly. While the stock selection is clearly bottoms up, but there is certainly a top-down layover on the portfolio in terms of how we are thinking directionally over the next 2 to 3 years. While we are not playing markets tactically, because currently at this point of time, all our funds are long only, but we certainly bring all of that understanding, and that helps us to buy a lot of sectors or companies within those sectors somewhat ahead before they become, before we start seeing price momentum into stocks, because we usually like to buy things ahead as a value investor. And when you're ahead of the cycle, it also gives you an opportunity to buy businesses at a fair price or reasonable price, and plus build your position comfortably when you're especially dealing with mid and small caps. So that's what we always try to practice, and that really helps us, I think, in terms of the investment outcomes that we achieve. I have always said that we have a very sharp focus on risk, because I firmly believe that we like to think about ourselves more as risk managers than portfolio managers. When clients entrust us with their capital, what we effectively do is we take risk on their behalf with their capital. And when we are taking that risk, it's very important for us to do a good job in managing that risk in our fiduciary capacities. So risk management is a very important part of our whole framework of investing. And more importantly, there are different ways of making money in stock markets. I'm sure there are multiple paths to achieving outcomes and success in stock market, which all of us are aware of. For us, while returns or outcomes are important in terms of whatever returns, performance, alpha that we or outperformance that we generate, but more importantly, we are very mindful and conscious of the drivers of return, our returns. What are the source from which we are generating returns? So one thing we are very clear is we don't want to generate returns playing market momentum or beta or high beta or taking high risk. We want a significant part of our returns to come from underlying growth in profits and cash flows of the businesses that we own. And many a times, because we own and we want those, that growth to be sustainable. So effectively, we end up buying good quality, high quality companies. And many a times, because these are high quality companies, they do get a valuation re-rating or uptick during our holding period or investment horizon. So we are very conscious that we want to generate returns through what we call sustainable drivers, which is through growth in profitability, cash flows, and by investing in good quality companies and not trying to play market momentum. More often than not, in fact, we are sellers into momentum. We are not buyers into the momentum. More often than not, being growth biased value investors, we are sellers into the momentum, because whenever you have momentum in stock price, eventually some point of time the momentum will deflate and you will have a price drawdown. So I thought I'll place before all of you all in terms of some of the key, tenets of our investment philosophy, which will help you place us better and understand us better in terms of, whatever outcomes that we are generating, what is the tenets of philosophy that's going behind generating those outcomes. So probably you all have a better understanding of one, what to expect from us, more importantly, what not to expect from us. Meaning someone is looking to for a fund which can play momentum or generate high beta returns, then clearly we are not those, that's not our DNA. So we are certainly not one of those guys who can do that for us. I'm sure all of you know this, but I thought I'll quickly just touch base upon it. As investors, we are absolutely growth biased. We always look to invest into growth and high growth businesses. At any point of time, we are going to invest into, while growth is a very important and fundamental pillar for us in terms of driving returns or returns that we seek to. But what is equally important for us is the quality of companies that we invest into and the quality of management team running those businesses, because stock market do make a distinction between good quality and bad quality businesses. Good quality businesses trade significant premium to poor quality businesses. So quality is very important, because eventually, however long term we are or we could be in our approach, eventually we are investors. So quality becomes a very important part of our framework in terms of investing. And as investors, we are very long term in our approach. So we want sustainable and durable business models which will survive worst of crisis. And once we get all these three things in place, then we want to make sure that we are buying those businesses at a fair price or reasonable price. So that's important for us. And this is our framework that we've been following from investing perspective, what I call sustainable quality growth at reasonable price. So we want to invest into high growth, high quality, durable or sustainable business models. And yet, while trying to put all of that in place, we want to make sure that we are buying those businesses at a fair price or reasonable price. I've spoken about our focus on risk management. It's a very important part of our DNA in terms of what we do. And more importantly, these are some of the things which I believe again gives us an edge over a lot of our peers, or helps us tide over short-term market volatility. We tend to be fairly long-term in our approach, or in a time horizon, as far as investment is concerned. And more importantly, at all points of time, we like to think about ourselves more as owners of a business than minority shareholders. So all of these things really helps us think deeper and think longer, in terms of our investee companies, businesses, and from a 360-degree perspective, and in a more holistic perspective, before we really put our money to work. So obviously, there's a lot of effort that goes into thinking and evaluating companies before. I've spoken a fair bit about risk. I thought, I'll highlight some of the risks that we try to manage or think through our investment process. We've spoken about qualitative risk and management risk. Likewise, we've also spoken about valuation risk. All of us understand that buying a high quality, high growth business, but at a very expensive valuation, can essentially mean that one does not make returns, or desired returns, and so valuations are very important. Likewise, while we are chasing growth and high growth most of the time, yet we are fairly conservative. We generally do not take financial risk and investee companies. So while we are willing to take business risk, our investee companies are companies which have little or low leverage, little or moderate or no leverage on the balance sheet. And many of the time, these companies are companies which are generating cash year after year, and they're classical cash machines. So we like businesses, which generate cash, and probably they end up sharing some part of that cash back to shareholders like us. So that's important for us, and we tend to avoid companies with significant leverage on the balance sheet. And likewise, we like our portfolios to have moderate volatility or market risk. We try to mitigate market risk through a quality and valuation framework, and make sure that our portfolios have risk lower than the benchmark or the indices. What are we trying to achieve? Sum total of all of this, what is the end goal that we're trying to achieve? I've always said that we have to, in world of investing is a risk asset class. So returns have to be looked or evaluated in the context of risk that has been taken to generate those returns. Returns cannot be seen in isolation because two returns are not comparable unless and until we measure the risk, underlying risk that has been taken to generate those risks. More importantly, while we want high returns, we also want sustainable high returns. And that is where the challenge is, that in a cyclical asset class like equities, we are seeking sustainable returns. And my view is that the path to doing or generating sustainable, healthy returns or high returns over a medium term to long term is through moderate risk and not high risk. People generally believe that to generate high returns, one has to take high risk, but I believe that's not the case. Probably because the person who's taken highest risk will also have the highest drawdowns. So high risk does not translate into long-term sustainable high returns in Indian equities, in equities anywhere for that matter. The path to high returns, sustainable high returns, is through moderate risk, and which is what we practice at Renaissance at all points of time. And this is a very core pillar of our whole investment frame on which our framework has been built. So this is the outcome that we're trying to achieve or drive our funds towards. So everything that I spoke about in terms of our philosophy or focus on growth, quality, sustainability, evaluation, this is the outcome that we're trying to drive it. How do we take moderate risk lower than the index or benchmark, if volatility is considered to be a measure of risk, and yet delivers outcomes or results which are better than the benchmarks? So that's very important for us. More importantly, we believe that investing is a game of probability, because we're always dealing with future, and the future is uncertain, and which is why we are just not blindly chasing returns. At every time we look at a company or a business or future returns, we evaluate that in the context of what are the probability of those events or outcomes happening. And for us, the expected outcomes, or as we call it, the return, meaning the returns ex post, will only be known in the future, right? When we investing at any particular point of time, we're looking at returns ex ante, in terms of what returns can be achieved over the next 12, 18, 24, 36 months. But the question is, it's very important to consider or take into consideration the risk that is associated with those outcomes. And in Renaissance, we're always trying to optimize our outcomes rather than just trying to blindly chase highest returns, which effectively bakes into the risk associated with those possible returns at any point of time, and which helps us to take wiser investment decisions rather, and helps us not to get carried away with short-term market momentum. So I think that's very important. And as I said, all of these are very much embedded into part of our investment process. And now they are very much part of our DNA. I'm sure all of you all have seen this, but I thought I'll highlight this. This is meaning the this is this is a very interesting slide. It explains what we've been able to do for our investors in our Indian XPMS in the last almost 5.5 years. Yeah. Now the upper box that you see here is the 3-year rolling beta of the fund. As you can see this, and this data is over a period of 2.5 years from April 23 to September 25. So effectively, it's a 5.5-year data. You can see that here we've very tightly kept the risk of the fund around 1 beta in the last 5.5 years that we've run the fund or this strategy. Yeah, which effectively reflects our view that last 5 years we've been positive in the market. So we've run the fund at full risk. And to us, full risk is equal to market risk. Under no circumstances, our framework allows us to take risk higher than the market. And we have not taken risk lower than the market because that would have amounted to leaving money on the table, which we clearly didn't want to do. So for us, risk management is an institutional process. It's not something whimsical that one fine morning I get up and I start taking higher risk, and then someday in the evening, we start cutting down risk because we fear something can go wrong globally. It's a very institutionalized process in terms of how we run our funds. It's a very process-driven thing. The bars you see here, friends, at the bottom are 3-year rolling annualized alpha. So these are 3-year alpha annualized, but of that our clients have actually experienced over this period of 5.5 years. The two inferences I want you to draw from this is over the last 5.5, 6 years, right from the start of the strategy, any investor, all these bars are upward sloping, which effectively means any customer who stayed with us for 3 years, we have generated alpha for them. We have done justice to our existence of a long only manager in their portfolio by delivering returns higher than the index. And those returns, the range of those returns or the dispersion of that returns is between 26% annualized. That happened for clients who came into our strategy in June or July 20 for 3 years ending July 23 to probably 5-year annualized for customers who came into our strategy in the year 22 for 3 years ending April to September 25. Well, the dispersion is wide, but the thing is 100% of our clients have experienced alpha. And I like to believe that even the lowest alpha of 5% that we're generating annualized over a period of 3 years is amongst the best in the industry. So that really tells you that, what I feel really good about is we've been able to add value to 100% of our investors. As long only investors or managers, we get judged on the basis of the alpha we generate over the benchmark, right? And I think which is what exactly we've been able to do. More importantly, we have done it through our process by making sure that we are not taking undue risks. So at all points of time, we've been very mindful of the risk we're taking in our portfolios. We have kept the risk very tight, and yet we've generated this outcome. I think that's the beauty of it. With that, maybe I can quickly share some quick thoughts on India and the outlook for India. I've always said this, or I've been saying this for a while. India is in the midst of a growth super cycle. This kind of growth super cycle in the life of any country happens once in 100 years, and India is in midst of that economic miracle. Every other developed country which is developed today have gone through these kind of growth super cycles in the past, be it Europe, be it US. All of us know, until 2015, the last 30 years was about China, and now this is about India. Yeah, it is just to put things in context. In late 50s, we were a $30 billion economy. It took us about 75 years to generate $4 trillion of economic output. Currently, as we speak, India CY25 is the first year on a calendar year basis where India is doing a quarterly output of $1 trillion. So calendar year 25, India is a $4.3 trillion economy. The point I'm trying to make, and I've always been making now, is the same economic output that we generated in last 75 years, we are going to generate in the next 7 to 8 years. So India is going to double the size of its economic output in the next 7 to 8 years. We'll go from $4.5 trillion economy to $8.5 trillion economy. If at $4.3 trillion economy, if we are a market cap of $5.4 trillion at 125% to GDP, and if we are going to double our economy in the next 7 to 8 years, then there's no reason why we will not double the size of this market, or the same $5 trillion of wealth we've created in the last 75 years. We're going to create the same wealth in the next 7 to 8 years. And we can't afford to miss this opportunity because these kind of inflection points in economy do not happen very often, and once they do not happen every 10-20 years. These are like they happen once in a century, and this is India's time at this point of time. Just to give a context, China was at similar stage at $3.5 trillion economy in 2007, and they doubled the size of the economy in the next 4 years. They became a $7.5 trillion economy in 4 years. India got to $3.5 trillion in 2022, but unlikely India will be able to do that in 4 years. What China was able to do it. I think, given the fact that the economies are very different, the way the economies are run and managed are very different, and the underlying growth drivers are very different. I think for India will take about 8 years to do that. So I certainly see India being a $7.5 trillion economy by the end of this decade or by 2031. And in the process, we will become an economy which will be $5,000 of per capita income and will double our consumption and investments. So I think we're in midst of that growth super cycle, undoubtedly. One thing which has really stood out for India this year, calendar year 25, has been the year of highest uncertainty that one has witnessed. I would say I have witnessed in my 28 years of professional career. One thing that has really held India well, despite all of this macro uncertainty that we've had this year, has been India's very stable macroeconomic fundamentals. Over the last 10 years, India has been a very stable economy. Our growth has averaged about 6.5% over the last 10 years, despite the COVID-driven shock which happened at the start of this decade. Our forex reserves are more than doubled from $300 odd billion in 2014. We are now $700 billion plus. Government of India has been very prudent in managing the economy, and they've been fiscally fairly responsible. Government has contained its fiscal deficit to 4.5% over the last 10 years. And as a consequence of stable, pretty healthy growth and stable macroeconomic fundamentals, obviously markets have taken a cognizance of it, and equity markets have gone more than 3x in the last 10 years. So, which is a pretty healthy outcome that we've been able to achieve. And I think this is what really stands out for India. More importantly, what I really wanted to highlight is India used to be a small economy, but not so anymore. All of us know that now we are the fifth largest economy in the world, probably getting to 4 very soon. By the end of this decade, while India will become pretty meaningful from a global perspective. And China had that dominance on the global economy, where a significant part of global growth was coming out of China over the last 30-40 years. But all of us know China has peaked, the growth is slowing and will continue to decelerate. But we are on an accelerating curve of growth. By the end of this decade, 20% of incremental global growth will be coming out of India, which effectively means by the end of this decade, the world will be looking to and would be dependent on India for its growth. India's growth will determine, have an impact on global growth. If India slows down, global growth will slow down. If India's growth accelerates, globally growth will accelerate. So that is how meaningful or impactful India is going to become, friends, in the next 5 to 6 years. And every other matrices or metrics or data points you look at is directionally going to improve very significantly, because we still have a lot of growth potential in this country, in this economy, in this society. I really see that India getting to a stage where we become pretty dominant and we get a seat at the table on every conversation around the world, be it geopolitics, be it economics, or anything that's happening in the world. India would have a seat at the table because we'll become very dominant from a global perspective. The world will be dependent on India. Sum total, what does it mean for India over the next 7 to 10 years? If all of this plays out, as I said, India gets to $8 trillion economy by 2032, 33. And if all of this plays out, then I think it's very reasonable for India to expect about a 14% CAGR returns on Nifty index. And if that be the case, then that should logically place India as amongst the best performing markets globally. And probably from where we stand, probably we should double India's market cap over the next 6 to 7 years. Some more thoughts on markets. So I thought I'll just share this with you all. The world has gone through multiple cycles, crisis, economic, geopolitical, in the last 25 years. Despite that, if you see over the last quarter of a century, and for a large part of this period, India was not the fastest growing economy in the world. Yet the top 50 companies in India, or Nifty as we call it, have compounded their earnings at 12% CAGR on a 25-year basis. Now, on 12% on a 25-year is a very, very, very strong compounding. You won't get this anywhere else in the world. You know, highest earnings growth we witnessed in the world by a leading, meaning by the indices or the frontline indices. That's what India has been able to achieve despite challenges and turmoil. So the point is, it makes imminent sense to stay invested, stay put with India's story long term. India has a long term potential. I would like to believe the next 15, 20 years, India's growth will be better than the last 25 years that we've seen, which effectively, I believe, some point of time our growth will be faster or better than what we experienced in the last 25 years. Because always remember, bear in mind, this is my firm belief and my firm conviction, the best of India is yet to come. The best we have not seen, the best is not behind us, it lies ahead of us. And as a consequence, Nifty itself has been a great compounder. This is something which you do annually at the end of every calendar year. Last 20 years, ending December 24, Nifty 50 has done a 13% CAGR returns, which is pretty much in line with India's nominal GDP growth at 12.5% and in line with Nifty earnings growth itself. So all of those returns that have happened in India have happened because of underlying earnings growth and not because of expansion in P multiples or valuations. So that reflects how strong underlying fundamentals of the Indian economy and the drivers of returns are very stable and have a very solid foundation. They are rooted in growth in profits and cash flows, and not on stock market momentum or price expansion or just price gains or P expansions, and which effectively makes us feel more confident when we look forward or zoom out into the future in terms of in the outlook for the future, because markets have a stable footing in place. The economy has a stable footing in place. I'm sure all of you will find this interesting. On a 20-year basis, these are again returns calendar year ending, and these are in dollar terms. Yeah. So 20-year ending December 24, the top 500 companies in India, which is BSE 500 in dollar terms, BSE 500 is the best performing index in dollar terms globally. At 11.3% compounded, 20 years ending December 24, BSE 500 is the best performing index in the world. The next best obviously is US S&P 500 at 10.3%. So I think that really highlights the great performance that India has been able to do and what we've seen in terms of India's economic resilience. Yes, last 10 years, US has done better than India, but on a 20-year basis, and again, last 5 years, ending December 24, India has done much better. Though I understand this year has been a year of underperformance for India, but even on a 5-year basis at 14.8% CAGR dollar terms, and these are dollar term numbers, friends, I'm just reiterating. So India has been amongst the best performing market in the world, and that makes us the India story very compelling. And it's not a surprise then that everyone across the world, be it Indians or foreigners, are very keen to put money to work in India, and they just need the right vehicle, right product, right manager, right advisor, and I think all of us collectively can do that job for them. Just to give you all some more context, people talk about India's growth potential and whether India's economy is peaked. So I thought I'll just place this in place. Yeah, just think about it. India is about a $4 trillion economy, and India's share of global GDP is just about 3.5%. So in a global context, we're still a small cap economy at 3.5, $4 trillion in a world which is about $100 trillion of economic output. And I think by the end of next decade, when India gets to a $10 trillion economy by 2035, my estimate, India will get to what I call a classical mid cap. And it's only when you get to, in global parlance, when we relate to markets and economies, it's only when the economy gets to 10% of global GDP, you say that the economy has become pretty large, and the economy has peaked out or will peak out at some point of time, because then there'll be headwinds to growth, because now you're very large in the global context. So you cannot outgrow the world, right? But I think that peak for India is sometime in the 40s. So we have what I'm trying to highlight, friends, is we have a very long runway of growth for India. So while India's growth is exciting, the runway for growth for India is very, very long. We clearly have 2 decades ahead of us, where India can still continue to grow at a very healthy rate, very high rate. And probably, I have no doubt in my mind that we will become 10% double-digit share of global GDP or global outcome. Just think about it, from where are we coming from? 2007, at the before the financial crisis, we were 2% of world GDP. Now we are about 3.6%. So we almost close to doubled our share of world GDP in the last 16, 17 years. And we're saying we will double that again in the next 10 years. And probably then double that again in the next 10 years. So the next 20 years, India's share of world GDP will go from 3.5% to 13, 14% over the next 20 years. And that's the time when one will have to start thinking that Indian growth has peaked, or we are near peak, something what China has achieved, and where we're seeing the China growth has peaked. But that's very far off, very far off. Maybe with that global top-down perspective, I thought I'll share some top-down perspective now that we're talking about GIFT City Fund, Dollar Fund. With a lot of you guys here, we keep talking markets and stocks. So I thought थोड़ा सा global ज्ञानबाजी करते हैं आज. And let me wear my Merrill Lynch hat. But now with that being done, let me just get over to introduce you to our Renaissance India Growth Fund. It's a Category 3 AIF based domicile out of GIFT City. The strategy or the approach for the fund is very simple. It will be a flexi cap strategies, investing across market cap. The portfolio will be about 30-35 stocks. It will invest in line with our whole investment framework of high growth, high quality, low risk, moderate risk, sustainable, durable business models, and a fairly actively managed portfolio. But our portfolio turnover ratios tends to be pretty low. Many of you know we are very lazy guys, low portfolio turnover ratios, high conviction, long holding period. These are all our DNAs, and all of that stays in place. Nothing changes. Just to introduce you, to give you some more details about the fund. So it's an open-ended fund, long only fund with a flexi cap approach. And the underlying currency or denomination for the fund is in US dollars. Kotak Bank is a custodian for the fund, so all the assets will be under the custody of Kotak Bank. We have Ascent Fund Services is the fund administrator. They're based out of GIFT City, and it's a global organization headquartered in Singapore. Recently, they got acquired by K Fintech, so now it's become a subsidiary of K Fintech. So they are the fund administrator for you. Vistra is the trustee. KPMG is our tax advisor, and BDO is the auditors for the fund. These are some details on the share classes and the fee structure. The minimum investments in the fund is $150,000, and going all the way to $1 billion. I'm looking for a $1 billion check some point of time in my life. On a more serious note, we have both fixed fee share class and a hybrid share class, where customers can pay either fixed fee, or customers can pay lower fixed management fees and then pay some performance fee basis after a 5% dollar hurdle. All of these are in dollar terms. We also have a share class here where customer pays zero fixed fee. So zero fixed fee, and we just work on profit share. We're happy to stick our neck out. Customers just don't pay any fees out of their capital. Any fees will be only out of the returns we make for the customers. And the administrative expenses for the fund will be charged at actuals. They should be less. They should be about 20-30 basis points. The regulatory limit we have is about 0.5%. The fund has some exit loads, friends. So the first 6 months, the fund has an exit load of 5%, slightly steep, yeah, but we want to discourage investors taking a short-term view on a fund. 6 to 12 months, the exit load is 3%. 2 years, 1 to 2 years, exit load is 2%, and 3 years, 2 to 3 years, exit load is 1%, and post 3 years, there's no exit load. So consciously, we've kept slightly steep exit loads because we really want customers to come into our fund with a slightly more medium-term, longer-term perspective, because we invest with that kind of a time horizon. So it's very important for us that customers align with our time horizons. Yet, we thought we will keep some exit loads. I'm skipping this for the moment. We have some institutional share classes for institutional investors that we can, in case of some institutional interest, our sales team can discuss that separately. While we've been running, these funds in India under the AIF, so I have for all of you all the dollar performance of our India funds or the AIFs that we've been running in India, and how they are looking, how those performance have looked in dollar terms. So as you can clearly see, on a 5-year basis, 5-year ending 30th September 25, our AIFs have done in dollar terms 28.2% CAGR return, versus Nifty 50 dollar returns of 14.2%, and MSCI India, which is more widely followed benchmark for global investors, at 13.9%. So the fund returns on a 5-year CAGR are 2x of underlying, indices returns, be it Nifty 50 or MSCI India. Likewise, on a 5-year basis, 3-year basis, the fund has done 15.7% CAGR in dollar terms versus 11% for the underlying indices. Last 1 year has been a bit challenging for the fund, but I think it has been for the markets. The Nifty index is down 10% and MSCI India 12% in dollar terms, and we've been down about 11.5% in dollar terms. But my view from here on remains constructive. I think probably the worst is behind us. The economy is showing traction. We're seeing light at the end of the tunnel, given the consumption recovery fueled by the fiscal stimulus. And I think we'll build on from here on this economic recovery. So we remain very constructive, and we can have a slightly more detailed discussion on the outlook for the markets. But I thought I'll present the dollar performance of our funds in dollar terms, and now given the underlying currency or denomination for this fund is in dollar terms. These are performance of our managed accounts, or what we call PMS in India, for our flexi cap and our large cap funds. I'm skipping this for the time being, but if you're interested, I'm sure many of you have it, but we can always come back. Again, very healthy performance. If you see on a 5-year basis, the Indian X PMS in INR terms has done 34.5% CAGR. And the opportunities PMS has done 23.5% CAGR, and pretty healthy outperformance over the index or benchmarks that we've been able to do over the last 3 years and 5 years. So again, pretty healthy performance. A lot of stocks have done well. These are some classical examples of stocks that have been part of our portfolio and which have done pretty well. Some or many of these companies are still very much a part of our portfolio. And some of these companies we held for almost, meaning like State Bank of India is something which we held for 7 years. It was part of our first portfolio that we started, and it's been there in the portfolio since then. And which is why I told you at the start of the conversation that as investors we are very lazy, and this is one example of how lazy we've been. कि एक बार stock ले लिया फिर हम बेचते ही नहीं है. Sun Pharma we bought in May 2019 and still part of the portfolio. So you can see how lazy we have been, or how conversely how patient we've been with our investing companies as long as they're doing a good job. These are some more details on some of the specific stock pickings. I can always come back if this is of interest to you all, but in the interest of time, I'll skip this. And we have some details on the funds. I think this is known to all of your friends. The GIFT City structure is fairly now we have quite a few funds out of GIFT City, so structure is well known. But in case you have any questions on the fund structure or on the onboarding process and this thing, Shalini and the team will be more than happy to help you all. So with that, maybe I'm already 45 minutes on the dot. So I think I'll take a pause and we'll open the floor for questions. Is that?
Thank you, Pankaj. Thanks a lot.
Sure.
If I may just request anyone with any queries to just type it in the chat box and we'll be happy to read it out. We will also at the end of the call be sharing this deck. We have a detailed FAQ as well for your reference. And of course, we have our relationship team across all locations for any onboarding support that you might require. So while we wait to hear on a few questions, I was thinking perhaps it would be a good idea to just highlight a few typical questions we've been facing as we've been talking to investors. So for example, a lot of people ask us who can invest in the fund, right? What kinds of entities? So all non-resident Indians, foreign nationals who have no linkage to India but are outside the country, could be a foreign company, an institutional investor, family office, or a financial institution, can invest either through a private or public company, partnerships, LLC structure, trusts. Internationally, you have foundations and charities, school, college, university endowments. So all of these types of entities are permitted to, invest in the fund. There is also a short list of who cannot invest. So some of these would include resident Indians. The logic behind this is that this is an inbound fund. The way it would work is that investors would bring in money from outside India into our GIFT City fund. We would then, through a FPI license, bring money into India and buy listed stocks on Indian exchanges. So therefore, it doesn't, it would be counted as round tripping and is not permitted. If Indian investors send rupee money to our GIFT City fund and that same money is brought back into India, so round tripping is not permissible. So rupee money of Indian investors cannot invest in our GIFT City structure. Similarly, non-individuals also, which are based in India, for the same reason, cannot invest. There are also a very short list of blacklisted countries which are on a FATF. This is the anti-terrorist task force list, which includes very limited names like Iran, North Korea, etc. Most other countries are permitted to invest. Some of them may come under a gray list internationally, which requires a little bit of a enhanced due diligence. But it's not like these clients are prohibited from investing. They're most welcome to invest with us. We have a question from Prerak on the Zoom, which is related to this question, which I'll just take. Prerak says we face a lot of issues when it comes to documentation for US citizens. Does a US client need to be in India or can he invest from the US? Will it be online or offline onboarding? So there are 3 questions here. One is pertaining to people who are technically US persons. Now, we are parallelly and very shortly going to be live with a feeder structure based in Delaware, which is our US jurisdiction regulated fund, which means that US investors will simply pool into this vehicle, which is very much a onshore US fund. And that fund will do nothing but bring money and buy units of our GIFT City. So clients, firstly, do not need to be in India. The whole purpose is to make documentation for them extremely simple. These investors can sign our application form very much sitting in the US, and our our Delaware entity will be very much a US fund. So it would be suggested to wait till perhaps early Jan to bring in US investors, because they will then be able to participate in the gift offering through a feeder fund, which will be based in the US. And that would make it extremely simple from a logistics perspective. The other question is, will it be online or offline onboarding? Currently in GIFT, so Soumya just asked, is it open for all USA and Canada investors? As discussed, we are setting up the Delaware structure primarily for our US investors. So that would be a far more convenient route for US investors to come in. Currently, as you know, we do have US investors in our rupee products. But the ease of, GIFT City is, and similarly Delaware, is that you don't need a PAN card, you don't need to set up a PIS account in India. There is no requirement to file taxes in India. So as a result, as a pure international fund, both Delaware and GIFT makes it extremely convenient to come in through these structures. The fund, we would, at this point of time, it really does not make sense for a US investor for the next month and a half to come into GIFT directly. It would be far better for them to wait, till early January, when we would be live for US investors as well. In terms of online and offline, this is true for all GIFT City as well as Delaware investors. The application form has a signature in just 4 or 5 places, does not require on an immediate basis for the physical agreement to be with us. But GIFT City currently does not recognize digital, which means the way we have, digital onboarding in India, where the client does not really have to physically sign an AIF form. The same is not yet completely accepted in GIFT. So the client really needs to sign on 4 pages of the agreement, and basis the scanned application, where his wet signature would be there, we would be able to onboard the client. So that's really how it would work. So in a way, a hybrid, it's not really digital, but we do not wait for the physical form to reach our GIFT City office. The entire onboarding, funding, deployment, everything can happen, basis a scan copy. So that's how, that would work. As there are no further questions in the chat box, I'll just take 1 or 2 other typical queries. Yes, this is an interesting one. Also, is the GIFT City fund currently feeding into India Next, which is our domestic flexi cap? Is it a replica? So firstly, the GIFT City fund is not a feeder fund. What that means is that it would actually bring the monies into India and buy stocks on the stock exchange, which means it would have its own portfolio as opposed to just having units of our domestic AIF. So it is not a feeder fund. It would have its own portfolio. And we would be able to do this because we would be opting for a FPI license, allowing us to bring the monies of the clients into India. Is it a replica? The strategy is similar, absolutely, yes. There could be slight changes in the actual portfolio depending on certain restrictions that are applicable, say, to FPI investors and so on. But in terms of strategy, will it be the same thought process as our India Next Flexi Cap? The answer is yes. While we wait for do we hedge currency? Sujan asks us, will you hedge currency? So Sujan, it's, while Pankaj can add, it's extremely expensive to hedge currency at most points of time. And therefore, we do not propose to hedge currency. So yes, while the NAV will be in dollars, the client will invest in US dollars and his redemption will be in dollar terms. The client will be running a currency risk. So as we know, the long-term average currency depreciation is typically anywhere from 3 to 4% if you look at the long-term average. So in general, today, when you're seeing the returns that Pankaj presented, et cetera, in dollar terms, we've actually, taken the impact of the dollar depreciation while reflecting our performance, right? So that's exactly what we are going to do, here as well, that the NAV will reflect the impact of the currency on an ongoing basis. So it is most international investors, from our understanding, would typically look at whatever's our rupee return historically, less about 3.5%, which would give them a sense of what the dollar, returns is what they would expect. And that's why a lot of our data in the deck as well, this particular deck for Gift City, has converted past track record, et cetera, onto a dollar basis. Yeah. So why would clients, who can technically even invest in our rupee products, why would they really look at Gift City? I think that's a logical next question. So there is a lot of benefits in terms of simplicity of investing through Gift City, which is that you don't need a PAN or an OCI card, for example. You don't have to prove that you're a person of Indian origin at all. You don't need to open a bank account or a PIS account or any such thing in India. The onboarding process is all on a scan, extremely simple. Reporting is in US dollars. So if clients have large global portfolios which are dollar denominated, it becomes extremely convenient for them to have a dollar denominated product, which then becomes a more apples for apples comparison. Like our domestic AIF, obviously taxation is paid for by the fund. The obligations are taken care of by the fund. And what the client sees is therefore a net of Indian taxation when he looks at his pre and post tax NAV. So it just makes it very simple and not have to operationally deal with Indian tax authorities and so on of any sort, right? So I think that's something that's pretty convenient. A lot of people ask us, is it open-ended or close-ended? So it is open-ended. The minimum ticket size to start investing is 150,000. We will have a monthly NAV, very similar to India, where you will be able to purchase as well as redeem units once a month. So that's something that would happen. So every month end, for example, we would have our NAV. Reporting, we'd have a monthly NAV, obviously an annual statement of, financial statement for the investors is how we, intend to do this. There are generally a lot of queries around taxation as well. While Gift City does have a lot of tax benefits for mutual funds and certain debt products, for equity, the India taxation of long-term and short-term gains largely applies. One benefit, of course, is that there is no GST concept in Gift City. Hence, management fees, etc., are obviously exempt from GST because such a concept does not exist there. Investors, even when they send us money, will have to keep in mind that there is sometimes small bank charges along the way. Our bank does, of course, not charge anything, but the investor's bank might have few minor charges, etc. So the client will have to ensure that net of all charges, the funds that reach us are a minimum of 150,000. So that's something to keep in mind. Clients can actually invest through any currency. So for example, if you have someone investing in, say, Singapore dollars, it would hit our account in US dollars. And when we send money out, it would also be as US dollars and it would hit the client account in Singapore dollars. So any kind of currency can be accepted. It's just that it would convert at the point of hitting our account into US dollars. So the fund only has US dollar denominated share classes. A lot of people ask us, can a NRE investor, invest with us? The answer is yes. Uh, Non-residents, as you know, could have either a non-resident ordinary or a NRO account, and there could be an NRE account or a non-resident external account. An NRE account actually feeds the source of funds is offshore, because these are repatriable bank accounts, as most of you would know, which means the source of funds is not money which has been earned in India. As a result, in a way, it is very much international money, and such investors can invest with us. NRO, by its very definition, the money has been earned in India either through rent, sale of property, sale of shares, etc., and therefore cannot be accepted into the fund. So NRE money, yes. NRO money would not be possible. Yeah. So I think this is the fairly typical set of questions that we've been, seeing. Can investors move on to higher and higher share classes with lower fees as they upsize with us? Yes, clients can top up their investments, and we would move them, to the next higher share class based on a request from them. Clients can also switch between two types of management fees. So if they come into fixed, they can move to the hybrid structure and vice versa. So I think these really complete most of our questions. A lot of people ask us, can a minor invest in the fund? Yes, a minor as well can invest in the fund, subject to certain basic, KYC documents. So I think that's really what I wanted to share in terms of what we're seeing as typical queries. Any other support or questions that you might come across as you, talk to your investors, please do let us know. We can keep expanding this FAQ. We will send our presentation as well as this FAQ document out to you. And, our application form, etc., is all available as and when you require. So please do let us know. So I think, Pankaj, we have no further questions. We've just also completed an hour exactly on this call. So with that, I think I'll take the opportunity to thank everyone for being, with us here today. It's a big initiative. It's been something that's taken a while in the making, as Pankaj said, and really came from the fact that a lot of our investors were really very keen to do this. I remember Pankaj going to Oman almost a year and a half ago, and all the investors there were second or third generation in Oman, almost no links to India anymore. And they were all very keen to look at a proper international dollar denominated offering. And obviously, interest in India was extremely high. So we continue over the last long time to see tremendous appetite for something like this, which is what really spurred us to put this vehicle together. The other big opportunity, of course, being US investors. I think that's a largely underserved bucket. And there as well, I think literally within under 2 months, we should have a full-fledged US feeder fund as well for your investors. So with that, thank you again for a very patient hearing. Have a great evening. And we expect to come across and meet you all individually in your respective locations to take the marketing efforts forward. Yeah. Thanks, everybody. Thank you, Pankaj, and everyone for joining this call. Have a good evening. Bye.
Thank you. Thank you. Thank you, friends. Thanks a lot for your time this evening. Thank you.
Bye.